Good afternoon. I'm Steve Springer. I'm one of the partners with Stone Rudolph and Henry CPAs, and I'd like to welcome you this afternoon to the latest in our series of seminars. Today's topic is the roadmap to retirement, something we all like to hope and dream about. And we have as our guest this afternoon Brandon Bork, a certified financial planner.
Sure.
And the owner of Roussel and Associates. And Brandon spends all his time dealing with clients, developing financial plans and helping them make smart decisions for their future. And so, Brandon, welcome this afternoon. Glad to have you.
Glad to be here. Thank you.
Yeah, and so we have kind of an outline of topics we're going to go through this afternoon. But if you have questions, you want to email in or send messages or whatever, we'll be happy to receive questions. And at the end of the session, we'll go over some of those if we have time. And certainly even after the session today, if you have questions, we would encourage you to call or email or set up an appointment or something, and we'd be more than happy to talk about the specifics of your unique personal situation. So welcome, and with that, we'll go ahead and get started.
Sure.
Brandon, we said this is a roadmap, so every roadmap has a beginning and an ending and a lot of things in the middle. So give us an idea of where do we begin this process of planning for retirement?
Yeah, absolutely. And with any roadmap, obviously the first step, if you're taking a trip, literally is to know where you are first, and then start to plan out from there. So just, roadmap to retirement, the financial planning process. We're going to talk about budgeting today. Again, that's a part of knowing where you are. Net worth is an important piece of knowing where you are. Social Security typically is an important component, most people's financial plan. And then we're going to go through a sample, what I call a financial profiles, that's very good. So, hold on just a second. Let me share my screen here. That'll make a difference. We're still all learning how to use Zoom, but we're getting there. All right. Sorry. So financial planning process, budgeting, net worth statement, Social Security, financial profiles. And so the financial planning process defined by the Financial Planning Association, which is one of the major bodies that kind of governs my side of the business. It starts with determine your current financial situation, develop your own goals. Somebody's goal may be to have $3,000 a month. Somebody's goal may be to have $20,000 a month. Some people may want to travel 4 or 5 times a year across the world or across the globe, so to speak. Some people may be just fine staying home. So everybody's financial goals, Steve, are different. So identifying those is certainly a key component. Identify alternative courses of action, evaluate those alternatives, create and implement a financial plan, and then reevaluate. And what I like to say pretty often in the process is financial planning ends with an ing,
right?
And it's not a plan we stick in the drawer. It's going to change. COVID-19 could happen and throw a little monkey wrench in there. So certainly something we've got to evaluate and monitor.
Right. Your first point there was determine your financial condition, where you are today, and that's so critical because we all are at a different point. Regardless of age or whatever our backgrounds may be, our income levels, we're all starting someplace different. So it's really important to have your own personal plan that you work with a planner on to be able to know, all right, this is where we are. These are my hopes and dreams. This is the lifestyle I would like to have in retirement, and how can I get there?
Yes.
And today's focus is on retirement, but we could interject other goals such as planning for college for kids, or it might be something else along that line. When can I retire?
Yes.
When can I make work an option instead of a requirement in my life? So that's why it's so important, isn't it, to have your own personalized financial plan.
Absolutely. It's not a cookie cutter type situation. Everybody's situation is different. Based on what their goals are. Somebody may have an inheritance coming and somebody may not have something like that coming in their life. So everybody's situation is different. Some may have 4 children they've got to put through college and try to plan for retirement. Somebody may not have children at all. So everybody's situation is different.
Sure, sure. Okay.
First step in the process of finding out where you are is a budget. And I know most people don't necessarily like that particular word or that particular function, but it really is a necessary step to know where you are first. And that's just knowing what the inflows are in my household and what the outflows are. And if you're, in addition to your household, if you own a business, knowing what the inflows and outflows are of that business are certainly important too. So what we've done on the budgeting piece is, trying to track that information is certainly where you need to start. And there's a lot of ways that you can do that. You can certainly start with just pen and paper, the old school method. You can use a spreadsheet if you want to use your computer, or there's some great applications out there. I personally today track most stuff through QuickBooks because that's where all my accounting stuff is QuickBooks. So, that's a great tool for me. But as we go through the budgeting process, people say, Brandon, what should be in the budget? And so we try to put some categories up here, and people have asked me through the years. I've been doing this 21 years now. And so I've just kind of collected and tried to be pretty detailed. So I'm just going to kind of toggle through these and not spend a whole lot of time on them. But obviously it starts with income, and income could be income from your job, could be income from a rental property, could be income from a business, lots of different ways that income comes through. And then the expense side obviously can certainly have certainly a lot of detail. So like under bills, I put, make sure you got your cable bill there, your electric bill, your garbage pickup. A lot of people forget little things, or on the insurance side, making sure that you remember that quarterly insurance payment and figure that into the monthly budget. So again, these were just a suggestion of the different options and things that you can put in the budget, but all of these, for the most part, folks have a place.
Right, and it gets even more complicated when you're self-employed.
Yes.
Because really you're dealing with a household budget and a business budget.
Yes.
As well. And a lot of people fear that word budget because they feel like it's handcuffs.
Yes.
I can't do anything if I have to live on this budget. Well, learning where the boundaries are, that's
I've got vacation in here at the end.
right. So it's in there.
So it's in there. Yeah, absolutely. We're gonna do some fun
Sometimes
stuff.
you have to prioritize, right?
Yes,
So,
that's exactly right.
so yeah, it's really important not only to understand the personal side of things, but especially those people who are self-employed need to do more planning,
Yes.
pay more attention to these types of things.
Yeah, like I mentioned with using QuickBooks, I personally have a personal function in QuickBooks that tracks all the personal stuff, and then I can toggle to my business inside of QuickBooks, and it tracks all the stuff in business too. So very important to look at both.
Right, and one of the most obvious outflows in anyone's home or business, taxes.
Sure.
And so
That's your area.
I know, but being sure that you don't spend everything that comes in,
Yes.
being able to set aside money to pay those quarterly taxes or however often people need to take care of those things. So important. So that is something that we spend a lot of time working with clients on. Is
Under
helping
taxes,
them
I've got
plan for that.
federal, Medicare, property, sales tax, Social Security. I've tried to put, just about everything in there. Again, people have asked me through the years, what categories should be in the budget? That's why we've developed this list over time to hand folks, try to help them, get started.
It's a good list.
Okay. After we know what's the inflow and outflows of the household or the business are, then we can start moving towards net worth. And so what we're doing there is we're trying to establish what items do I have, what do I own, and some items are retirement planning items for the roadmap for retirement. Some items are just items that I own. A boat's not going to it might be something I own and own outright, but it's not necessarily a retirement asset.
Right.
So
Now, some people may be wondering what that word means.
Yeah.
Net worth. That sounds like an accounting term or a finance term, and it is.
Yeah.
But simply, it's just what you own,
yes,
the value of what you own versus the debt that you have on that, right?
correct. Assets minus liabilities equals net worth.
Net worth. So it's basically the equity that you have in your home or in your
Yes.
vehicle or in your whatever it might be.
Yes.
Okay.
And just like the budgeting list, I've got a good list for that, which I'm gonna share with the group. So let me do a new share here and make this. Give me just a second here to make this full screen. Okay, so just lots of, this is just a nice little list of, artwork could be something that you own that's a part of your assets, bonds, business equity, cash, IRAs, jewelry, all those are things that are assets. And then if we toggle down to the next page, this just kind of gives you a nice little list of liabilities or debts that could be out there. And so at the end of the day, again, you can just be as simple as using a pen and paper or a spreadsheet, list out just exactly what I have and then exactly what's in each account and then what my debts are and then assets minus liabilities. And I'm actually going to put up here a sample net worth statement. But this just kind of gives everybody a nice list of the categories that go into all those different pieces. People forget about, I got this credit card over here. Well, that got to go on the liability side,
Right.
So everything needs to go on that sheet.
It's one of those kind of things that you need to determine how frequently you're going to check this. What is my net worth today?
Yes.
Versus what is it 6 months from now or a year from now? Because obviously what that tells you is, are you paying off debt? Are you accumulating more assets? Or are you going the wrong direction? If you take it on more debt, then, and maybe your assets have gone down in value. So it's helping you to determine, are you making progress?
Yes.
To getting toward that goal, right?
Yeah, and I try to teach folks to at least look at it once a year. I have some folks that look at it monthly. I have some folks that look at it quarterly. But just getting in the habit of measuring, it's just a yardstick to measure the process and where I am in the process. And again, it's a part of that roadmap, that foundation of where am I? And once I know where I am, then we can start moving on those goals to the future.
Right.
So let me put up a sample, just net worth statement that I think would be good for everybody. Again, I'm gonna put it on full screen view, and there we go. Hang on. Asset type. So again, in a normal net worth statement, it breaks it up into cash, assets, qualified plans, which would be retirement. IRAs, 401ks, annuities, investment accounts, which would be like a brokerage account. Real estate, so that adds up all the assets. The second page to that statement has any liabilities. If I've got a mortgage on my real estate or my home, a personal loan, a credit card, and then the next page just kind of puts all that stuff together with a nice little neat number at the bottom saying, here's my assets minus liabilities, here's what my net worth statement is. And so to your point, my goal is to try to increase that number, and that's why we measure it. And a lot of that increase hopefully comes from planning for retirement, putting money into assets that are going to produce income. When the back gives out, they'll produce income from that standpoint.
Okay.
All right. Let me go back to the slideshow. Okay. Social Security. This typically ends up being a really important component of most financial plans for folks today. And so these percentages here are actually, they come straight from the Social Security Administration. For folks that are 65 and older that are on Social Security today, this is kind of the breakdown of their income that they're receiving typically in retirement. And Social Security for most folks today is a third of that plan, on average.
Right.
So it's a very, very important number.
That may be surprising to some people and not to others.
Sure.
We deal with all types of people who come with different levels of assets and earnings and that kind of thing. But it's no surprise to me. I deal with a lot of clients who that is a huge portion of their retirement once they get to that age.
Yes.
Probably wasn't what Congress originally intended. It was kind of that filling the gap kind of thing to make sure that people's could maintain a certain standard of living, the basic essentials of life.
Yes.
But we as Americans aren't really savers, are we? By and large,
Yes.
those who are smart and really plan for it,
Yes.
wind up with some money in savings and retirement plans and that kind of thing.
To help supplement,
Right.
Social Security.
So
Yes, absolutely.
Social Security is absolutely critical to a large percentage of our population here in the U.S. And I'm not sure how many people we have on Social Security or whatever at this point, but one of those things I've heard my whole life is, will it be there when we need it? How can we be assured that Social Security is still going to be around? Well, I'm 59 years old, and I've heard that my whole life,
Sure.
and it's still here,
Still here.
and actually probably in pretty decent shape from many accounts.
Yeah, if you look at your statement, and they used to send out a statement to everybody, regardless of your age, every 2 years. Now you do have to go online to get that statement if you're younger, than age 60. So you can go out to www.ssa.gov, and if you register, then you can actually pull your true PDF that you used to get in the mail that shows your age 62 number, your age 66 or full retirement, number, which is 66 to 67, depending on what age you are and where you fall on the scale. And then age 70 is kind of the max number. And so having those numbers in the financial plan, it's really important. If you're sitting down with somebody that is a financial planner, it's really important to bring those numbers for that individual. So lots of options.
Yes.
You could take it early at 62.
Right.
You could wait till normal retirement. You could wait to 70. So my mother's turning 70, and she just called me actually last week to tell me when her payment's going to start in August and exactly what the number was. So she waited all the way to 70. My grandmother lived to be 96, so she's been in good health. She probably should have waited, and that's what she's done. But everybody's plan's different, obviously.
And there's some obvious, pretty large differences in the amount of benefits that you receive. If you start at 62 versus you wait to your full retirement age, which for many folks today, that's 66 and however many months.
Yes.
And then I think if you wait till 70, it's like an additional 8% per year. So
Yes.
you could wind up with, say, another 32% increase.
Yes.
Above what your full retirement age would have been. That could be pretty hefty.
Yeah, every year that from 66 to 70 that you put it off, it grows by 8%. Can't guarantee that in the stock market right now. So
no, that's a good return.
Yes, it is, but that's only if your plan and your health allows for you to
Right.
be able to wait.
Right.
So just kind of toggling down here. I think we've covered some of these questions already in our conversation. How do I qualify? You've got to have 40 quarters of earnings, and so through 4 quarters, that's basically 10 years of earnings and paying Social Security taxes. That's how you qualify. How much will my benefit be? Obviously, that range is based on how long you've worked, your earnings history, how much you paid in. And so again, if you go pull that record from Social Security, it'll give you your as close to an estimate, based on your current situation. What happens if I delay my benefit? We've talked about that. It continues to grow, and that can certainly be a good thing for people that can't allow that to happen. Can I work and draw retirement benefits simultaneously? Yes, you absolutely can. And in most plans, we are doing that. We're pulling money out of an IRA or to supplement income in addition to the Social Security. And then are there benefits for qualified family members? Yes. A lot of folks don't realize if I've got a spouse, whether they work or don't work, we're actually, creating a benefit for each other, especially if we both work, or if we've never worked outside the home, we're creating a benefit.
Right.
So there's lots of options there. God forbid I pass away, there's some death benefits for family and kids and stuff of that nature. So a lot of wrinkles to Social Security.
There really are. And, sometimes we see some planning opportunities when people, self-employed people, for example, let's say there's a small business, a husband and wife, and they both work in the business, or they don't, one way or the other. Sometimes it's advantageous to have both spouses in the business so they both can get some earnings credited toward their Social Security history, right?
Sure. Yeah, to increase that number,
right?
For both of you.
Sure. So there's some ways to be flexible with that to make sure that both spouse has
self-employment
income on their record out there. So.
And I know one thing that Stoner Ruff and Henry's been doing for the last several years is if a client will bring you their Social Security statement from the government, the SSA.gov, y'all have got some software, and that's it's a great tool to use to try to see how to maximize my Social Security, and that's something y'all been doing for several years.
Absolutely,
it's been very beneficial to your clients.
Yeah, you're right, because as you mentioned, you have different points that you can jump into the system.
Yes.
Age 62 or 66 or 70.
Yes.
And being able to evaluate what your earnings are from other sources and determine what's the optimum time for you to start taking advantage of those benefits. There's real value in having that information. And sometimes, people don't realize they have benefits out there that they're unaware of, such as if they had a divorce.
Yes.
And a previous spouse had some earnings, and there are some time frames that they could still become eligible for
absolutely
drawing benefits from a former spouse and things of that nature.
Yes.
So there's a lot of,
or God forbid somebody passed away before you got to retirement.
Exactly.
There's going to be a benefit there.
Exactly.
That's already earned.
Exactly.
So
yes, that is a service we provide, and I think it's a real value to people who aren't to that point yet, or maybe they're just getting to that point where having to make that decision. Do I go ahead and sign up, or do I not? There's not one easy answer. Sometimes it takes some evaluation to determine what is the best solution.
It is definitely not a one-size-fits-all.
No, it's not.
And right now, unfortunately, with the Social Security Administration, office is closed.
Mm-hmm.
You can call the 800 number, which is interesting in itself, but that's a difficult task. So anyways, if you can get your info, be a lot of help there.
Right.
For sure. But it's a very critical piece of the pie for retirement. And I think I believe we may have already covered most of these. Will Social Security be around? Obviously, there's some adjustments that probably will need to be made. Congress seems to make those through time. I don't believe it's going to go away tomorrow. That would certainly be a situation that would be, I don't think that's going to be the case for sure.
But in most plans, we assume it's going to be there at some level.
Yes,
right.
Absolutely.
Yeah.
So for folks that, in most of my plans that I put together for our firm, we typically cut the benefit back a little bit, and we typically cut back the inflation fighter just to build a little fudge in there.
Yeah, a little cushion. Yeah.
Absolutely. Just because we know there may be some adjustments through time. But at 65, even if you don't sign up for Social Security, everybody does need to go at least sign up for Medicare,
right.
Even if you're still working Part A,
right.
Just to have that piece taken care of. So then all that can be done either through the 800 number or the website nowadays. So you're user-friendly from that standpoint. Moving on. Financial profiles. So once we've put together the budget, Steve, once we've got the net worth statement and we know what our numbers are, and then we kind of have our Social Security, we need to take all these facts and we need to put them into a software system that can actually say, here's where I am today on my roadmap for retirement. And if I project forward that, there's going to be some growth, obviously, in the assets, that I'm adding to assets, that I'm building my net worth, where is that going to put me? And so if you haven't taken that step, we got to have all the facts. We have those, and then we can take that step. And that just takes the retirement plan of what do my goals need to be? Here's where I want to be. And this is where my plan says I'm going to be. If that's not where I want to be, then okay, now it's time to, take that plan and start working on it, reevaluating it, looking at it, and helping, make decisions to get you where you want to be.
Right.
So the financial profiles is a software system that, we use, and there's lots of different options that are out there. Most financial planners have, options at their fingertips, and with the internet and all the tools and wonderful capabilities we have today, those tools are out there to use. Some of them are just ones on the internet that you can go find. But I'm going to walk you through just a sample of what we typically use. And so I'm going to share that one of the final reports it puts together. I think that'll be somewhat helpful. Let me get back up here to the top. Okay, And this is just kind of the very first part here with the red bars is just establishing the need. And so in this scenario, this particular Sam and Sarah sample, which we use a lot, obviously, in this particular scenario, it was $7,000 a month is what I would like to have. But again, everybody's plan's different. Somebody may need 3, somebody may need 15. Everybody's goals and aspirations are different. And so what this is showing you is, and I think in this particular scenario, Sam and Sarah are like 52, 50, something around those ages. It adjusted for inflation. So if I need $7,000 a month to live on today, that's actually $119,000 when I get to age 65. So we've got to adjust this plan for inflation. Okay.
Right.
And it puts a capital figure down there. Don't get hung up on the number that's down there, the 2.1 million. I'm going to show you where that kind of comes from. But again, everybody's number is going to be a little bit different. But this kind of establishes what is the need. Okay. This next page on the right side, it establishes the number for every year based on inflation. And again, we're trying to build fudge into the equation, so to speak. And so from this standpoint, you can just see what does that number grow to between now and say age 90. Okay. Right. And it's a software system, so we got to put a finite number, an ending number in there, but certainly help everybody live to 95 with great health, but we kind of break retirement up into what we call the go-go years, slow go, and no-go. And if we get somebody to 90, 95, 96 like my grandmother was, that's usually no-go.
Right.
Sitting on the front porch. In this slide, it's showing that your Social Security is going to have a capital figure associated with it. So I'm getting that income stream. And so those dollars are coming through. That's part of my retirement plan, part of that $2 million in this particular example that I needed. And so what it calculates out to be is $752,000 is the actual number I'd have to have in the bank to replace that Social Security benefit. Gotcha. So my other assets, a business I sell, a traditional IRA, a 401k, those assets have to be that million, that difference, right. The number, that's the difference. So this kind of establishing the numbers. This screen shows my Social Security's coming in on the right side. It just says, this is what my other assets have to produce to have that same income through time. So it's kind of layering on Social Security first, what's left over from my other assets to actually put together. And then we just kind of come down through here. This gives an example. So for instance, for Sam, when we did this plan, he had $100,000 in his 401k. We try to grow everything at 5%, being conservative. Certainly the market through time, depending on how much risk you want to take, can pay 6, 7, 8, and that's our goal. But I want to build a plan on 5. That's the way we've always, an average of 5. That's the way we've always been very conservative, try to be very conservative. So in this scenario, Sam's adding to his 401k every year, and then it's obviously growing. And so the ending value would be 781. That's just an example of how these assets grow inside the software, projecting it forward. Where will I be? Okay. And again, it's financial planning.
Right.
It's got an ing on it.
It's an ongoing process.
Yeah, that's exactly right. And so after we put all that information in, we come to this screen to say, okay, based on Sam and Sarah's goals, they're about, they've got a shortfall. And so now we can start talking about, okay, should I put more in the IRA? Should I put more in the 401k? Should I work a year or two longer? Just try to shore up, or maybe I don't need $7,000 a month. Maybe I could live the life I want to live on $6,000. So there's all types of adjustments that can be made to the plan to accomplish and get us to 100% of our goal. Obviously that's the end goal is we want to be at 100% and fulfill all of our dreams from that standpoint. Okay. So this software just, and again, there's lots of different versions. This particular one we use, but there's lots of different versions out there that can help you project stuff forward and say, where am I on this roadmap?
And you can run multiple scenarios, right?
Yes.
So if someone says to you, Brandon, I want to retire at 58.
Yep.
Or, what could I expect in monthly income if I do that versus if I wait to 62 or 66?
Yes.
Things of that nature. And so time is one of those key elements of
Yes.
in the plan. And you mentioned inflation.
Absolutely.
And then, what are some other things that might come in? Taxes,
Sure.
obviously.
Absolutely.
We have to make some assumptions about what's going to happen with taxes. And
We have to make some assumptions about growth. Like I said, the 5%. We got to make some assumptions about where tax rates are going to be. And again, those are all things that encompass the ing.
right,
Ing.
because it changes.
It's going to change. That's right.
After,
Tax rates change. The market changes.
who would have dreamed in January of this year
Yes.
what our life would look like today in June?
Yeah, I mean, typically you would have been doing this meeting. Everybody would have been having lunch together and spending time as a community.
Right.
And that's typically how these meetings have been done in the past.
Right.
But here we are doing a Zoom meeting today. So
Yeah. So now
it's changed.
we in the last few months we've seen trillions of dollars of government debt added to be able to dole
Yes.
out money to the public to help keep the economy going.
Yes,
Probably more of that to come.
potentially.
So all that has to be paid back at some point with taxes, obviously. So
Yes.
now's the time to be rethinking tax rates.
Yes.
What do we expect in the future? I don't expect rates to go down. If anything, they're going to go up. So
Yes.
somehow we have to pay for all this. So yeah, it is an ongoing process because things beyond our control make our plan change.
Absolutely.
Yeah. Okay.
For sure. So these are a lot of the components, again, starting with the budget, where am I on the inflows and outflows? If and a lot of people do already track their net worth. If you don't, that's something you need to try to start tracking, because you have to have those numbers to try to put this type of projection together
Right.
and know where I'm headed and what I'm trying to accomplish.
Right. Now, I've heard you mention this several times already, but you've said the word health and referred to it. That is such a huge portion of our retirement planning, isn't it?
Yes.
Just planning for health insurance and our health needs. And so
Yes.
when you sit down and work up a plan with someone, you discuss with them health history, right?
Yes. And family health.
Family history. Just
Yeah,
to
absolutely.
kind of know what you might expect. Are you from a family with longevity or not?
Yes.
And things to make assumptions about. Maybe you need to have special needs, money set aside for special needs in the future. Nursing home care, things of that nature. So all that gets factored into these plans, right?
Yeah, absolutely. And then there's situations where sometimes you're not just worried about yourself. Sometimes you've got a parent you've got to help, or you've got a child you've got to help. So again, everybody's plan is different.
Right.
It has a wrinkle or two that certainly has to be adjusted through time.
Right.
And I may be healthy today at 44 years old. I may not have that kind of health at 62, or may not make it to 62. There's lots of things that can happen along the way.
Sure.
To change the plan.
Right.
So
Good.
let me go back to the slideshow. Okay. I think we covered the financial profiles. Questions? Don't know if we've got anything that's on the chat function from folks.
Okay. We'd encourage you, if you do have questions, to go ahead and send those in now at this time. I think there is a feature on your screen where you can actually key in some questions. Brenda, I often get a lot of the questions I get from folks, emails, are about specific types of investments. And really, that comes far into this planning process,
Yes.
just when you get to the point of recommending specific types of investments. But there are some rules of thumb, aren't there, when it comes to the types of investments you might be in. And what I'm thinking about is often there's fixed and then there's growth types investments like stocks.
Yes.
Versus fixed items like bonds and CDs and other types of things. And what might some people be considering as they're making those investment decisions as it relates to their age? So let's say you're 5 years from retirement or you're 10 years from retirement. What might a portfolio look like at those time intervals, and how might it change over time?
Sure. From a standpoint of that, really you're talking about risk tolerance
Right.
and time horizon. And so some folks have a higher tolerance for risk and some folks do not. Doesn't matter what age they are.
Correct.
You know, so there's some people that are my age that are ultra conservative, and that's okay. There's some people that are older that are ultra conservative, or there's some folks that get close to retirement and are more aggressive. So again, everybody's goals and their risk tolerance level is different. But typically, as you get closer to retirement, you want to pull back on the risk meter. And because, you know, we're no longer putting money into that investment where it's growing, we're now starting to pull money out of that investment.
Right.
And so when the market goes through swings like it did this year, and I'm pulling dollars out as well, then that's when we need to have a little bit more conservative type approach from an investment standpoint. So as you get closer to that, you know, 65, 66, 70, you know, typically we see folks pull back on the risk meter, and instead of being in a, you know, 80% equities, 20%, you know, bonds type portfolio where when I was younger, I could just let it go. You know, maybe I'm 50-50, you know, between equities and bonds, or I'm 60-40 because I don't have time to make up that market going down and coming back up. You know, time's a little shorter.
Right.
So typically what we see is as we get closer to that number, or we're already in retirement, we've pulled back on the risk meter pretty substantially.
Yeah. So like my 25-year-old daughter, who
Yes.
she's in her first year of employment.
Yes.
You know, right out of grad school.
Right.
And thank goodness she listened. She is putting the maximum amount that she can into her retirement accounts and all that sort of thing. But at her age, if she is overly aggressive and the markets go down, she has time to make it up, right? She has, you know, theoretically, there's time is on her side.
Yes.
But the older she gets, if you wait till you're 45 to start putting money into retirement, or 55, then time's no longer on your side.
Right. Absolutely.
So you have to consider the risk even more at that point, because if the markets do go down substantially, then you don't have the time to make it up, or you have to change your time horizons.
Yes.
You can no longer retire at 62 or 65. You may have to keep working to make up that deficit.
Yes.
So.
Absolutely.
So I see what you mean. This is an ongoing process. It's planning, not just having a plan.
Not just a plan. So we've got one question. Someone was asking about required minimum distributions for 2020, and through the CARES Act that Congress passed, they have suspended having to take those dollars out for 2020. And so some people, if they took it earlier in the year, again, they've already taken it. But for most folks, typically they take it either throughout the year or later in the year. In this particular scenario, because of the CARES Act, that's not something that you have to do.
Right.
You can still take the money if you need it, obviously, to live on.
Sure.
But if you don't need it, you don't have to take it for 2020.
Right.
And we'll just have to see how this whole situation plays out as to whether or not there will be any new changes to legislation going forward for 2021.
Sure.
At this point in time.
And one of the other changes that happened along that same line is, you know, as long as I can remember, the age at which you must start taking those required minimum distributions has been 70 and a half. And so now we know that people who are getting to that age, they can actually wait till age 72. So that's a change that has happened in the last year as well.
Yes.
And so that I've had several clients who thought they're going to have to start taking distributions this year based on the old rules, who now are actually very pleased. They can let that money sit there for another year and a half and grow instead of being forced to start taking that out. So that's a good option for a lot of folks.
Absolutely. Anytime we can let the dollar stay in there and continue to compound interest.
Right.
That's a good thing.
Yeah. But for those folks who are already taking distributions,
They got to continue.
they have to continue under the old rules. This is only people
But not
who
for
are,
2020.
right.
Again, planning.
Right.
It changes.
It does.
COVID-19.
Exactly.
I think we've got a question about Medicare. It's a question about drug coverage. You know, typically most folks do have a prescription drug plan. That's kind of covers your Part D for Medicare. I've got some folks that I refer most of those types of questions. That's its own little world, so to speak, with the donut hole and all the
Right.
different options that are out there. So be more than happy if somebody reaches out. I do have someone that's very good at answering those questions. And in the course of financial planning, it's impossible for us to know every little detail. So that's why we have wonderful partners that help us on that stuff. So I would really, if you'll reach out to me or Steve, I can get that information to that particular individual, and they can really dive in and do a much better job than I would do.
I may refer them to my 85-year-old mother who has become an expert at Medicare insurance, and she teaches me things all the time about it. So.
Yeah, one question is we're asking about tax rates over the next 5 years.
Yeah, I see that. What tax rates are you projecting in the next 5 years? Well, I don't have a crystal ball, and I don't want to stick my neck out, but I would say, if anything, they're going up.
Yeah.
You know, if I was right now, if I was in the position, and I had this conversation with a client yesterday who just recently sold her business.
Okay.
And in structuring when she gets the money, you know, whether she takes it all in 1 year or over 2 years or 3 years, that was part of our consideration was, what do we expect tax rates to do?
Yes.
And one of the things we looked at really hard was the fact that rates are probably as good as they're ever going to be in my lifetime right now.
Correct.
We have low long-term capital gain rates that range anywhere from 0 to 15 to 20%.
Yes.
And they've been that way.
Yes.
For a long, long time. You know, a lot of those rules go all the way back to George Bush at times.
Yes.
And amazingly have not been changed at all. But I can expect, logic just tells me that somehow we have to pay for all this additional national debt we have.
Correct.
And so taxes is really about the only, other than cutting spending, that's probably not going to happen.
Sure.
But, you know, raising taxes is probably a likely scenario. So to guess how much, there's no way I would guess. But yeah, I would say if you're thinking about, should I take income now? Should I take it next year? At least consider that the taxes may very well be higher next year or the year after or the year after that.
Sure, absolutely. Okay. Being self-employed, do you recommend a Roth IRA versus saving for retirement? Well, a Roth is another retirement vehicle.
Right.
The Roth is where I have paid the tax and I never pay tax ever again. So from my vantage point, it just, again, it depends on each person's situation, but we have a graduated tax scale in this country. We've always had it, where you pay more on your last dollar than you do on your first dollar in retirement or through the year as you look at your tax return. And so it makes sense from my vantage point to have a little bit in both pre-tax and
Right.
after tax, so that you got both buckets to pull from. And it depends on what tax rates you're doing or what your situation is each year as to which bucket we pull from.
Right.
So typically we pull from the pre-tax bucket to try to take advantage of those lower tax brackets initially throughout the year. And if you get to the end of the year, then oftentimes you're pulling out of the Roth bucket to try to stay out of those higher tax brackets.
Right.
So from my vantage point as a planner, there's a need for both in your planning
And I see that a lot with our tax clients as well. We have a lot of couples where maybe one spouse does the traditional IRA and the other does the Roth.
Sure.
Just so they have that two different pools to draw from, as you were mentioning.
Yeah.
The other thing there, and the question was, being self-employed, do you recommend a Roth? For me, it's more about how old are you than whether you're self-employed or not. Roth works really well for you if you're young.
Correct.
My 25-year-old daughter, who I referenced a while ago, that is a great thing for her to be putting money in every year. Go ahead and pay the tax on it now. Rates are relatively low. And then, as Brandon said, all the growth that occurs in that IRA over the next 40 years, 50 years of her life is tax-free.
Yes.
So starting at age 25 is the real key versus if someone were 55 and asking me that question.
Right.
Yes, there's still some advantage to it,
Yes.
but not nearly as much as if they had started at 25.
Correct.
So an IRA has a lot more value to a 25-year-old than it does to a Roth IRA to a 25-year-old than to a 55-year-old.
Again, depends on everybody's situation,
Right.
what they're trying to accomplish.
Right.
Okay, we got some questions. Says, what about safe investments given the current economic situation, especially if it doesn't recover very soon? Great question, and all the questions that have come across. Thank you very much for participating and sending us information. Obviously, the market has been shaky. We've had a huge swing. The Dow Jones and the S&P 500 went down 30+%, you know, from the highs of February to the lows of March. We've recovered off of those, off the lows, so to speak. There probably will be some more volatility that will come, but I'm a long-term believer in the market. If you study the market, you know, and you look at a chart of the market, it goes up over time. And so again, it comes back to, am I in the appropriate risk allocation? And if I can't sleep at night with my investments having, you know, half in the market or 60% in the market, then I need to change those allocations.
Exactly.
I need to get with my financial advisor and help them, you know, it's a collaboration between the two of us or with a couple or a group. You know, it's a collaboration of what is the right mix so that I can sleep at night. So yes, I do believe there's certainly some more volatility that's going to come as we continue to, but I still believe long term the market will adjust. It adjusts when tax rates change. It adjusts when wars happen. It adjusts when, you know, economic cycles happen. Elections, all those things, the market seems to, over time, it adjusts and does go back up. So again, that's more of your risk tolerance, you know, type scenario. We talked about the Roth for a legacy fund for heirs. Roth is a fantastic vehicle to leave behind for the next generation. Again, tax-free. So certainly be more than happy to talk to somebody more about that in the future, but it is a good vehicle because the traditional IRA or 401k is all taxable to either you or the next generation.
Right.
You know,
Right.
So, but the Roth is not.
And the rules have changed on that.
Yes.
Wow. Up until this year, there were some really great techniques
Stretch
you
it.
could use.
A lot of that's been changed.
With an inherited IRA, the beneficiaries can stretch that out over their life expectancy.
Yep.
Now it's all changed. Now they have to get all those dollars out on an inherited traditional IRA within, well, and even retirement, other qualified
401ks.
retirement plans within 10 years.
Yes.
So,
that can be year 1 or year 10, or
right.
you know, any year in between that.
Yeah, I'm thinking the 29th day of December in the 10th year would be a great strategy.
Well, it depends on where tax rates
Depends
are.
on tax rates. Depends on where they are for that year. So it takes some planning. Right. Okay. Other questions for us? Someone asked about a worksheet for helping determine net worth. I bet we could come up with something we could send you. If you would send us your email address, and we'd be happy to send you out something. That literally is just making a list of your assets, put a value on them, make a list of your debts with the amount on them,
Put a value on them.
and take a difference between the two, the difference between assets and liabilities. So, but we could probably come up with something that would help you kind of get started to making your list. So some general categories probably.
Another great question about required minimum distributions that someone's asking, is it a specific amount or is it a percentage? And it's actually a factor table. Google is my friend. I go out to Google all the time. You can literally Google and pull up that required minimum distribution table.
Right.
And so it basically starts at age now 72, and there's a factor where you take, I've got $200,000 in my traditional IRA, I divide that factor in there, and that determines my amount. And it's determined by your 12/31 balance each year.
Right.
So whatever that closing balance for the year is, and that's why they suspended taking the required minimum distribution this year, because the balances were high, the market went down, so then I was having to take money out of an asset that was down.
Right.
For sure.
Right.
Okay. I am approaching retirement age. It's better to pay off my debt, car loan, mortgage, or increase my contribution to my 401k before I retire. We're always big proponents of paying down debt.
I am.
As I go into retirement, the least amount that I've got to pay out of that income stream that I'm trying to use for living off of, the better. But again, it depends on your goals.
I would agree with you. It depends on where you are
Yes.
financially and what your goals are. Most of my clients, I definitely tell them one of your goals should be to be debt-free before you retire, because I just think that frees you up to have so many more options in retirement. But I have a few clients, not a lot, who literally could say, I will never spend all my assets because I don't spend a lot of money. I've saved.
Sure.
I have a really good retirement or pension or something coming in. I get health insurance, through my retirement or whatever. And so realistically, I'll never spend all my assets. Would I discourage that person from going to buy a condo on the beach, and having a mortgage on it? Probably not, because they could afford it. But everyone's situation is different. For the average person, myself included, I don't want to enter retirement with debt. So that's a good general planning rule of thumb, I would say.
General rule of thumb, many people that doesn't bother them. They can sleep just fine at night, and their plan may allow for it. So everybody's situation's different. Let's see here.
See the one at the top, what appreciation rate?
Over a 10 to 15 year time horizon, what appreciation over on a stock portfolio. Again, I don't have a crystal ball. Steve doesn't have a crystal ball. Conventional wisdom would say potentially that growth will be off or down based on the economic cycle we're in today over that time period. But who knows? We had a lost decade, when I started my career, and then the last 10 years, the market's nearly tripled. So it ebbs and flows, but that's why we typically try to build plans using that 5% conservative number, knowing that through time, history tells us that we're going to get closer to that 6, 7, or 8, depending on what kind of risk you want to take.
Well, in the plan, don't you want to go as low as possible? Because if you can meet your goals at 5%, then you're really going to be happy if it actually hits 10.
That's exactly right.
So that's kind of the key there.
Yes.
Is to build into that plan as low an assumption as possible, so that if that meets your needs, then you're going to be real happy if it goes above that.
Yes. All financial planners want to help you have more money than life. Mm-hmm. And so that's why they go conservative with those financial plans, and that's what they should do. Okay. Asking about the PPP loan forgiveness and whether or not a portion of that's going to be taxable.
Right.
I know they're still trying to get guidance and regulations about how that works. Okay.
Yeah. Just a reminder here that if you do have questions, you might want to send them to my email address. I'll go ahead and give it to folks so you can make note of it.
Sure.
And that's Steve, STEVE, at SRH, like Stone Rudolph Henry, followed by CPAS, Certified Public Accountants, plural.com. So Steve at SRHCPAS.com. Yeah, go ahead and send us an email, and we'll follow up with you on any additional questions. Absolutely. But to answer the question about the PPP loan, yes, as long as it's spent for the right purposes within the right time frames, then yes, you're looking at those payroll loans being forgiven. And no, it's not taxable income, but one of the things to keep in mind is some of those expenses may not be deductible because expenses related to tax-free income are not deductible, and that's not a new rule. That's been around for decades. So that would, if you have specific questions, be a great time to sit down or with your accountant or call them or email them or something and say, here's what I'm looking at. I got $30,000 on a PPP loan. I've been able to spend it within the required time frame, and how is that going to impact me? Now, the good news is within the last couple of weeks, they've changed the rules once again. So on these PPP loans, it originally was you had to spend 75% on payroll. Now that number's down to 60%.
Correct.
Originally, you had 8 weeks to spend the money. Now you have 24 weeks. So it's going to be really hard not to get forgiven. You know, they've really made it very flexible because I think Congress had that intent from the start.
Sure.
They wanted it to be forgiven.
Yes.
You know, so it's going to be real hard for it not to be forgiven as long as you spend it on
Those
what it
items.
was intended for.
Yes.
Right. So
Absolutely. And I think there will be more guidance coming.
there is
Different
more
situations.
guidance every day. We're relearning this. It seems like on a daily basis the rules change.
Yes. Let me make a correction. Good comment from talking about the drug, plans. Yes, you do need to be enrolled in a drug plan, and if you don't take medications, you still need to be enrolled so that you can avoid any kind of penalty in the future. So I appreciate somebody following back up with the comment, and I apologize if I misunderstood the question on the front end. But when you sign up for Medicare at 65, or you get off of your employer plan, you need to make sure that you've got your drug plan in place. But again, those are questions that I typically send out to other folks because I don't deal with that specific little piece of the pie every day. So I do appreciate the follow-up because that makes a big difference.
Okay. What other questions might we have here?
Email one more time, and I think we've put that out there so that y'all got that information. The questions have been fantastic, so thank you very much for participating.
Right.
Again, when we're sitting in front of an audience, this is a little easier for people to raise their hand, and you can usually see somebody's expression and know they've got a question or they got a comment, and so we really appreciate people either doing it through the chat function or the question and answer function and helping us, go forward.
Okay. Well, let me throw out a question then. Well, there's a couple other questions here from the audience. Let's see.
Paying taxes, July 15th.
The new date in July this year for paying taxes to the IRS. Yes. If you owed taxes for 2019,
yes,
then July 15th is your last date to pay those, or you're going to be late after that. And also, if you are one of those lucky people, self-employed or whatever, who are making quarterly payments, quarterly estimated tax payments, then your first 2 quarters for 2020 are both due on July 15th of this year. Okay.
Yes.
So I have several clients. One today, I got a tax return out where they owed money for 19.
Sure.
And they've got to make their first 2 quarterly payments for 2020.
Sure.
All on July 15th. So
that's a chunk.
That's a chunk. But it just worked out that way this year.
Yes.
But I guess the good news is it's been sitting in your bank account for 6 months, earning some interest. So.
Not that bank accounts pay. No,
Right, they all don't pay that much.
It's low these days.
Anyway.
It's just where we are in the interest rate
Yeah,
cycle.
I was going to bring up this next question. What are your charges for a personal consultation? How does that work?
Yeah, so we typically will sit down with somebody and spend an hour and a half with them and just try to see where they are and where we might be able to fit in. And there's no charge for us to take our time and do that part. We're looking for, just like you and your business and most people that are business owners or executives, or we're looking for long-term relationships. And so we're not looking for just some kind of short-term transaction. So, there's no meter running behind me when I'm sitting down with somebody for the first time, and I know that's the same way for you, Steve, when you're trying to evaluate somebody's tax return and where they are in their business and how you might be able to plug in and help. And so it's the same way for our business. You'll just sit down, let's see where you are, see where we may be some help. And if we can be, we'll talk about that. And there are, certainly situations where we can and some situations where we can't.
Right.
So from that consultation, just sit down, there's no charge.
Right. And you've made this point over and over that it's planning.
It's planning.
It's not like somebody walks in and you hand them
Yeah.
a finished product and say,
Yes.
good luck with this,
Sure.
hope it works out. It's
Yes.
something that you meet with them frequently and revise the plan and help them work the plan. So
Yes. But if they haven't taken the steps we've talked about today, that's typically where my first meeting goes. Have you looked at your budget? Do you know what you have or don't have?
right.
Have you looked at Social Security? All those steps that we've taken everybody through today to get on the roadmap to retirement, that's the steps that I take somebody through if we've never met before. So whether you work with somebody like me or somebody else, if you can take that information to that first meeting, that really is helpful on that first meeting to try to make sure you're on the same page and where to start.
someone else in the time that, we have 1 minute left, but in the time we have regarding PPP, I'm an independent contractor, so self-employed.
Mhm.
My only employee is me. How do I prove payment to myself? You need, so I'm assuming you got the loan, and how do you prove that you paid yourself? You need to write yourself a check. You're taking a draw out of your
Yes.
business account.
Yes.
So, so I'm assuming that that's the case for you. You put the money from the loan in there, and I've advised clients to write on the bottom of the check, PPP loan money,
Yes.
or something, just to note
Yes.
which of those disbursements came out of those funds. So yes, you definitely need to have some kind of documentation as to be able to prove to the bank and ultimately the SBA and the federal government how that money was spent. So.
And again, they're continuing to release some guidance on that.
Yeah.
And I think their intent, like you said on the front end, was forgiveness. And there needed to be some different,
Sure.
you know, and so they've made some adjustments. There may be more adjustments. That'll come.
We keep hearing that a lot of the smaller loans may not even get much of a review, that only big dollar loans will have a lot of requirements as far as documentation. So we hope that's the case. Folks, thank you so much for allowing us to be with you this afternoon. We appreciate your time.
Yes.
You taking the time out of your schedule to join us. Great questions. We look forward to the time when we can all do this in person. We have seminars just about every month on different topics here at the firm. Brandon, thank you for being here this afternoon and for all your input. And I know that you'll be happy to meet with any of these folks if they would like to get in touch with the office here at Stone,
Yes.
Rudolph and Henry,
Yes.
648-4786. They can help facilitate setting up an appointment with you.
Sure.
And folks, we'll reply to your questions if you'll send us an email. And
Yes.
once again, my email is steve@srhcpas.com. Thanks again. Have a good afternoon.
Thank you very much. Hope everybody has a great rest of the day.